Imagine spending 4 months negotiating the purchase of a $900,000 business. You paid for due diligence, you hired an attorney, you got to the finish line, and then the lender comes back and says they need more information. Not a denial, a delay. 6 weeks of back and forth requests while the seller starts wondering whether you can actually close. Most deals that die at this stage do not get rejected outright. They get delayed until the seller loses confidence and moves on. In almost every case, the problem traces back to something the buyer could have fixed months earlier before they ever made an offer. It was sitting in their personal financial statement the whole time. There are 5 things your personal financial statement reveals to a lender, and most buyers have no idea any of them are being evaluated. Welcome to Main Street Ledger. We cover small business acquisitions, SBA lending, franchise ownership, and business finance. If this is your first time here, subscribe below. This is research and education, not financial, legal, or investment advice. Here's what most buyers get wrong from the start. They assume the lender is evaluating the business. The lender is, but they are evaluating the buyer first. One of the first financial documents a lender receives from you is your personal financial statement. Before they have looked at a single year of business tax returns, before they have reviewed the seller's financials, they have read your personal financial picture. This is not an SBA quirk. Commercial bank lenders require the same personal financial disclosure. SBA has a specific form, Form 413, but the principle applies anywhere a lender is deciding whether to put their money behind you personally. Most buyers treat the PFS like routine paperwork, something to fill out once the deal is already in motion. Sophisticated buyers do something different. They maintain a current personal financial statement before they start looking at businesses, not after they find something. Because the form tells you whether you are ready to buy before a lender does. The knowledge gap here is specific. Buyers in the $200,000 to $2 million range often understand business valuation reasonably well. They understand that SBA loans require down payment. What they do not understand is how lenders read them personally. That is what this video covers. 5 things your personal financial statement reveals to a lender, and one additional category at the end that does not score you at all. It does something else entirely. Most buyers think the lender is looking for one number. They are not. They are looking for 5 different signals, and the first one is the easiest to misunderstand. The first thing your personal financial statement reveals is what we call the net worth test. This is the entry point. The lender looks at your assets, your liabilities, and the number that remains. Most buyers assume that a strong net worth figure means the conversation is over. It is not. Net worth is what gets the lender interested. It is not what gets the deal done. Think about our HVAC buyer. Purchase price of $1 million, SBA loan of $900,000, equity injection required of $100,000. On paper, this buyer looks financially solid. Home equity of $350,000, a 401k worth $420,000, a brokerage account, a checking account. Net worth over $800,000. The lender sees that number and keeps reading. What they find next is where the conversation changes. The second thing your personal financial statement reveals is what we call the liquidity test. This is where most buyers get surprised. Net worth and liquidity are not the same number, and confusing them is one of the most common and costly mistakes a buyer can make. Our HVAC buyer has $800,000 in net worth, but look at where that wealth actually lives. Home equity of $350,000 is not liquid unless the line is already drawn. A 401k worth $420,000 is not liquid for this purpose. Some lenders will accept a rollover into a qualified structure, but that takes planning and time, and it cannot happen the week before closing. What the buyer actually has in usable funds is a brokerage account worth $40,000 and a checking account with $18,000. That is $58,000. The equity injection alone requires $100,000. Add estimated closing costs of $20,000 to $30,000, and the post-closing reserves most lenders want to see. And the shortfall is not a rounding error. It is a real problem. SBA guidelines typically require the equity injection to come from liquid seasoned sources, meaning funds that have been in the account for 60 to 90 days. So the lender sends a request. They need documentation explaining where the closing funds are coming from. 2 weeks pass, then 3. The buyer is scrambling to pull together bank statements, brokerage records, and a written explanation. Meanwhile, the seller is still running the business and fielding calls from other interested buyers. The deal is not dead, but the window is closing, and the buyer is the reason why. The third thing your personal financial statement reveals is what we call the obligation test. Lenders are not only counting what you have, they are counting what you already owe. Vehicle loans, a home equity line of credit with a balance, credit cards carried month to month. None of these are automatic disqualifiers. Together, they tell the lender how stretched the buyer already is before taking on a new $900,000 debt obligation. Lenders typically evaluate this through global cash flow, which is total income measured against total obligations across the personal and business picture. Our HVAC buyer has 2 vehicle loans, a HELOC with a balance, and credit cards carried regularly. The lender does not ignore these. They weigh them. Most lenders look for personal credit scores in the mid-600s at minimum, with scores in the high 600s generally preferred, though lender practice varies. The point is not that existing debt kills deals. The point is that buyers should understand exactly how their obligation picture reads before a lender sees it, not after. The fourth thing your personal financial statement reveals is what we call the consistency test. The PFS does not exist in isolation. Lenders cross-reference it against 3 years of personal tax returns, bank statements, and credit reports. When the numbers do not align, underwriting slows down and questions begin. SBA Form 4.13 requires figures drawn from statements dated within 3 months. Estimates must be labeled as estimates. A buyer who rounds numbers, omits accounts they consider minor, or lists an asset that does not appear anywhere in their supporting documents creates a documentation problem. Lenders do not interpret inconsistencies charitably. An unexplained gap reads as either careless or intentional. Both conclusions create friction. Every number on that form needs to trace back to a document the buyer can produce the same day it is requested. The fifth thing your personal financial statement reveals is what we call the credibility test. This one surprises buyers the most because it is not about a number at all. The PFS is one of the first pieces of financial writing the lender receives from the buyer. How it is completed tells the lender something before the first meeting happens. Blank fields where none or N/A should appear read as sloppy. A missing spouse signature on jointly held assets is a common trigger for additional documentation requests. How assets are held matters. Whether contingent liabilities are disclosed matters. A divorce agreement with ongoing financial obligations, a co-signed loan, a personal guarantee on someone else's debt. These belong on the form. Leaving them off does not make them disappear. It makes them a problem when the lender finds them somewhere else and lenders look. Now here's where this video goes somewhere different. Everything we have covered so far assumes you are being evaluated. The lender is reading your net worth, your liquidity, your obligations, your consistency, your credibility, and forming a picture of you as a borrower. That evaluation is what the 5 tests are about. This next category is different. In some situations, the evaluation never starts. The government debt disqualifier is not a test that scores poorly. It is a condition that stops the process before scoring begins. An outstanding federal tax obligation, a delinquent federal student loan, or a prior SBA loan default will typically disqualify a buyer regardless of how well they perform on every one of the 5 items above. Lenders are required to check. Most buyers do not know the check is happening. This is not a hypothetical. Deals have collapsed at this stage not because the buyer was financially weak, but because a government obligation nobody mentioned was sitting in the background. The damage is not just the lost deal, it is the months of work that preceded it. Attorney fees, due diligence costs, the time the seller spent, the time the advisory team spent, none of it recoverable. The fix is a 5-minute check before you ever look at a listing. Know your federal tax standing, know your federal student loan status, know whether any prior SBA loan history exists in your name. That check costs nothing. Not doing it can cost everything the process consumed. Here is what to take away from this video. The personal financial statement is not paperwork the bank needs after you find a deal. It is one of the first documents that shapes how a lender thinks about you, and it arrives before most buyers have given it any serious thought. Net worth and liquidity are not the same number. A buyer with $800,000 in home equity and retirement accounts may have less than $60,000 in funds that actually count toward closing. SBA guidelines typically require the equity injection to come from liquid, seasoned sources. A 401k and home equity do not automatically qualify, and finding that out late in the process is expensive. Every number on your PFS will be cross-referenced against your tax returns, your bank statements, and your credit report. If it cannot be traced to a document, it will become a question that slows everything down. If you are serious about buying a business, your personal financial statement should be completed before your search begins, not after your offer is accepted. Before a lender decides whether the business is worth financing, they are deciding whether you are the kind of person they want to finance, and that decision starts with the form most buyers fill out last. If this video gave you something useful, subscribe. There's a lot more where this came from. Research the deal before you fund the deal.